Welcome to today's webinar, Contained Credit Uncertainty and Stress Testing Practices, sponsored by Ardmore Banking Advisors. There's no question uncertainty and rapid change are prominent in today's environment. Therefore, stress testing is critical for managing risk and meeting regulatory expectations. This session will show banks how they can use practical stress testing techniques to strengthen capital, liquidity, and credit oversight. Let's get started.
Thanks, Lori. Hello, everyone. My name is Peter Chirpak. I'm a partner at Ardmore Banking Advisors and a longtime partner with ProSight and its predecessor, RMA. We're experts on credit risk management for community and regional banks. And today's presentation about stress testing, we think is going to be very interesting for our audience. And we have some specialists in the area to talk to you today. We're going to look at not just the commercial side, but also liquidity and the deposit side in this webinar. So we think it's going to be very interesting for everyone. Thanks to ProSight for hosting this webinar, and I'm sure that you're going to find it interesting, particularly due to the current conditions, as Lori already alluded to. We've been working with community banks and regional banks on credit stress testing since 2007, when the first interagency CRE guidance was published. And it really started an evolution of stress testing from being something that was a specialized activity for only large banks to becoming really a best practice in credit risk management for all banks. It's really evolved over time into a regulatory expectation and a practical example of proactive credit risk management. Before we get started, I'd like to introduce our panel to you. So first, from Ardmore Banking Advisors is Todd Sardich. Todd, could you please introduce yourself to the audience?
Thank you, Peter. My name is Todd Sardich. I've been with Ardmore for a little over 12 years now. I lead the consulting practice for the firm that includes stress testing. Prior to Ardmore, I have been in the banking industry for over 25 years. Most recently, before Ardmore, was the Deputy Chief Credit Officer for a Midwest bank. And I, along with Peter, are considered, the stress testing industry experts at Ardmore that are assisting our clients with all types of portfolio stress testing that we're going to be talking about today.
Thanks, Todd. Eric?
Thanks, Peter. I'm Eric Siegel. I'm a partner at CFO Consulting Partners. We are a CFO services firm, and I lead the financial services practice, which is a practice that is focused on community banks and fintechs, including crypto companies and asset managers. Our services are to CFOs, CEOs, and boards who need help in finance at a senior level. And we do a lot of work with stress testing in terms of asset liability management and helping our clients design their stress tests and interpret the results. And I've been with CFO Consulting Partners for 16 years. And prior to that, I had a 20-year career at American Express and Ameriprise Financial in various roles in finance and accounting.
Excellent. Thanks, Eric. So as you can tell, we have some really good expertise on the panel today, and we're going to explore not only these two areas of stress testing, but also why this is important today in particular. I'm going to start out with a quick overview of stress testing, because stress testing means a lot of things to a lot of people. And, there's Dodd-Frank stress testing, balance sheet stress, credit concentration stress testing, liquidity, capital. There's also that thing that happens when you get to your 50s and 60s where you have to run on a treadmill. Oddly enough, that's a great example of what stress testing is, because what you're doing when you do a stress test like that is you're running on a treadmill, you're simulating a lot of exercise in a controlled environment with experts watching what's going on and tracking your activity. Similar thing here. We're going to be stressing the bank in various aspects, monitoring what happens with experts watching and tracking the results. So that's sort of an idea of what stress testing is. Let me first show you the agenda for today. Overview first, then commercial concentration, credit stress testing. We're going to then get into the best practices of that. Todd's going to walk you through some examples. Hopefully you can get some takeaways that you can use yourself. Then we're going to let Eric talk about liquidity stress testing, giving us an overview and then getting into the best practices of that as well. And we'll wrap up with a quick discussion about why this is particularly important in today's environment of uncertainty. So let's just give a quick overview, a context of what we're going to be talking about for the next 45 minutes or so. What is stress testing? We've talked about briefly already. It's an idea of really preparing yourself for what could happen and to help bankers make better decisions, more informed decisions about management. It's predictive in that the idea here is we're looking about what could happen in the future. We are not as focused as looking backwards at what did happen. It also helps us deal with potential vulnerabilities that are either internal with policies or something that happens within the institution and external, including what's going on in the marketplace. It is somewhat a directional view of potential either depositor or borrower behavior and what the potential resulting impact could be on the bank's capital and liquidity. One of the important areas is it can help you really quantify the potential risk. It might be something that basically as a risk manager, there's a problem here, but it's difficult to quantify what the impact could be. This sort of an exercise can do that for you. And again, it's proactive, which is something examiners want, the board wants, and certainly shareholders want, is that you're proactive with risk. And really, to do stress testing properly, and both of our panelists are going to discuss this, it needs to be a repeating, actionable program. And it's got to be as complex, really, as your institution is complex. So smaller banks don't need to necessarily have a very complex modeling quant approach. Larger banks might want to get into more intense modeling aspects of it. So this is a regulatory expectation today. Regulators expect you to be doing stress testing. It's, again, forward-looking. I think that is something that you have to recognize, that a lot of risk management is looking back at what happened in the past and sort of looking in the rearview mirror at the results. With stress testing, you're looking ahead at what's coming at you and what could happen. So it's really a great way to evidence for examiners, the board, management, that you're looking for best ways to proactively manage risk. It helps answer these 4 essential questions that you can see on the slide here. Do you have sufficient capital given your risk appetite and profile and the economic conditions? Do you have sufficient liquidity to withstand changes in your deposit base and other liquidity aspects of the balance sheet? And are there segments that are potential problems or are more vulnerable than others, whether it's types of depositors, whether it's types of deposits, whether it's concentrations of credit? And then should you adjust your strategy? A good stress testing program should be informative and help a banker take action. Just sort of to summarize this is a slide from the most recent OCC semi-annual risk assessment. And you can see that they start out with sound credit risk management practices and stress testing at both the portfolio, commercial and retail, and facility level from a commercial perspective is considered the formative sound credit risk management practice. That which leads to timely and accurate information systems and reporting, effective concentration management, and timely and accurate risk ratings. So this is, very timely and fits well with the environment that we're in today. This is the results of a poll that was recently published in the Bank Director website and in their information. And what I think this is a great summary to wrap up this overview is how do banks use stress testing today? And you can see that over half of those polled said that they use it to adjust their liquidity plan or policy. This is something Eric's going to speak to shortly. They also talk about adjusting their asset-liability management strategy based on the results of stress testing. So these are some pretty important things for a bank to consider at the highest level. Adjusting a capital plan or policy could be the results for both retail liquidity and credit concentration. And then, of course, we get into more detailed concentration aspects like commercial real estate, which is still top of mind today, taking a look at repricing risk, those loans that are going to renew in the next 6 to 12 months, considering the interest rate environment and the uncertainty that we're seeing, and then rebalancing securities portfolio. And you can see all the way down to a quarter of the people said they're planning on changing their elevated credit loss projections and agricultural concerns about their credits there. So stress testing can do a lot of really good things for the bank, and there are a lot of different ways to do it. That's my overview, hopefully to give you context on what we're going to go through. And I'd like to do is turn this over to Todd now to give us an overview of commercial credit concentration stress testing, and then talk about some of the best practices. Todd?
Thank you, Peter. At the end of the day, when we're looking at stress testing, and I'm going to go through these piece by piece by the bullets here, the foundation of any stress testing exercise is going to be data. At its core, stress testing, as Peter mentioned, is providing a series of what-if scenarios, creating scenarios in which to stress a portfolio in a different way, or a series of different ways to have insight into what could happen should there be adverse economic conditions. The challenges that we see and the challenges in this program of stress testing is data availability and reliability. A lot of times, different key elements that you're trying to utilize in the stress testing process, be it appraisals, be it cap rates, net operating incomes, or cash flows, a lot of that information could sometimes be stored in different systems, whether it's a spreading system on the credit side, whether it's an appraisal system. The key is to make sure that you have a repeatable process where you can obtain this information, maintain this information moving forward when there's changes, and be able to extract this information. It's the garbage in, garbage out principle. So really, data is a foundational piece of this in making sure that the processes in place to obtain this data are repeatable moving forward. The next part of the process really goes into segmenting the portfolio, performing what is shown here as a concentration analysis. This can be done in a series of different ways, dependent upon what type of stress testing you're going to be doing. For example, when you're looking at CRE stress testing, we want to look at that by a property type. Is that a hotel, a retail center, office, et cetera? When you're looking at the C&I side, you're focusing on high-risk industries. What are high risk either in the economy today or to our particular portfolio? This is particularly useful today as we look at uncertainty we face in the economy with tariffs and what is happening with imports and manufacturing and things like that, that really have the ability to impact the bank's portfolio in the future. Other things like geographic locations. Perhaps a bank is operating in two geographically diverse areas that would have different results. You might be on the coast or in the southern area, a large portfolio there, and you might have a large portfolio within another area that's less susceptible to economic change or fluctuation. So getting an idea of the portfolio and the risks associated with concentrations and performing that analysis is really, after the data is kind of the foundational piece of it in which you want to move forward with. Scenario development, at the end of the day, building a scenario or a series of scenarios is going to give you the kind of the timeline or the bookends of what you want to look at for stress testing. And what I mean by that is, a lot of times you're going to want to stress it on an initial basis, where it's just a very small stress, and then setting a midpoint out at the other end, where it would mirror something that happened at the last economic major event, such as the Great Recession, and somewhere in the middle. Typically, we like to see, and we recommend you develop an initial, a moderate, and a severe scenario. These scenarios are going to basically define the adjustments that you're going to make in your economic variables, whether it's pushing cap rates up or reducing cash flows. Those scenarios will be built around that. And I'm going to go a little bit more into the results in a subsequent slide to talk about that a little bit more. When we talk about metrics, we want to develop metrics through all types of stress testing in which to measure against both benchmarking against what we expect it to be, and then what is kind of an industry standard and what will happen with these. These could be things like LTVs, debt service coverage ratios, ultimately potential impacts to capital. Defining those metrics is important. And then at the end of the day, when you do all this, you have the data, you build the scenarios, you segment the portfolio. You want to be able to provide actionable insights and what does this mean for us? Does this mean potential impacts to our policy? Do we need to make changes to certain loan types dependent upon the stress testing results? Were they very unfavorable, and maybe the structure of the credits that we're underwriting maybe should be looked at? Also, what does it do to our capital? What is our downside risk to capital should these economic scenarios or situations come to fruition? So, creating a plan in order to give the board and senior management and your internal risk management group insight into what could we do with this data is very, very important.
Yeah, thanks, Todd. Before we go on, just you let off with the importance of data. If a bank doesn't have all the data that you need to do a stress test, does that mean they shouldn't start their program at all? Can you start a stress testing program without all the data that you might need?
Certainly, yes. That's a good question. I mentioned it is a challenge for a lot of banks, and depending upon the complexity and the size of the banks and how much data they're storing. So, starting out with some data and building that over time is one option. Another option is to use proxy data. There is economic data available for property types. If you want to look at cap rates, if you want to look at other things, changes in market value for appraisals, or changes in industry dynamics, utilizing proxy data, I'll call it, as an industry metric to use is one way to start. But at the end of the day, you obviously want to build that database into your own data that's going to reflect the metrics of your own portfolio. So yes, the answer to the question is yes, you can do that, and you can build it over time. Certainly, it shouldn't preclude you from starting the process. But at the end of the day, you want to work towards building an infrastructure in place that you can have your own data.
Right, that makes sense. I mean, I think the 80-20 rule can help you out as well. The largest credits first. All right, let's move on then. Talk a little bit about the inputs and measurables.
Yeah, absolutely. So I mentioned earlier on the previous slide about measurables, and I have these broken out here by different types of stress testing that you're going to do. Predominantly, a lot of stress testing now has historically been done on the CRE side, on the income-based real estate side. A focus that we're seeing in the marketplace now is with C&I, particularly measuring against loans within the C&I books that are susceptible to the impending economic challenges that we are currently beginning to face and could face more in the future. So starting with CRE, I mentioned LTV. As you're making adjustments to appraisal values, reducing those appraisal values, or alternatively using a cap rate approach, a direct capitalization approach where you're measuring cap rates and net operating income, and you're increasing cap rates, it's obviously declining, your value. What is that ultimately doing to our loan to value for that segment? It's likely going to go up in trending that. At the same time, we want to measure debt service coverage ratios. As we're declining or decreasing on our stress testing scenarios, we're decreasing cash flow. What is that doing to the overall debt service coverage of the portfolio? This could be done. Any of these metrics can also be done on a loan by loan basis or on a pool basis. Typically, when you're doing portfolio stress testing, you're doing these on a pool basis, measuring these variables on into a weighted average and trending that weighted average as it changes with the metrics that you're using in the scenarios. Interest rate stress testing is obviously a concern right now with the interest rate environment, which is stabilized. But the problem that we're seeing is there's the impending refinancing and maturity and repricing that's coming up. A lot of that is in 2026 nationally, but it's going to be there. So what does that look like when you stress the portfolio on an interest rate basis? At a current rate, what is that going to do to these other metrics? What is that going to do to your cash flow coverage, et cetera? And pushing all these metrics through capital. At the end of the day, we want to see what does this mean for us from a capital standpoint. As the LTVs exceed 100% and cash flows fall below, say, 1x, what is the capital implication on a per loan basis, and then aggregating that information up to the segment in order to translate that to capital. I went on to I mentioned a little bit about CNI. Very similar process here from a scenario development, but the measurement is a little bit different. Since we're not dealing with income-based real estate and we're looking at traditional CNI lending and cash flows, we want to be measuring things like leverage. As the financial information changes, the underlying financial information changes from the operating statements of the borrowers, what is that doing to leverage? Measuring liquidity in the borrowers, and Eric's going to speak more about liquidity stress testing. This is really dealing with the liquidity of the borrower, not of the bank. And again, cash flow. Cash flow is important on that. Other items in construction, banks that have large construction portfolios, they might want to look at absorption rates. And as slowdowns in absorption occur, what is that doing to our eventual sell-off of the project and ultimate pay down or payoff of the loan and of the facility? Cost overruns in today's environment. And we saw this during COVID too, at the beginning of the COVID when prices shot up. What is that doing to material costs, and how is that affecting the budgets that you originally had set when you set up the project? And what is that ultimately doing to your funded amounts? As completed LTVs, what is stressing those appraised values of an expected as completed LTV? What is that telling me? So these are just examples of some measurables. It's certainly not an all-inclusive list, but it gives you an idea of things that you could be looking at when you're building this program out.
Yeah, thanks, Todd. Do you feel that due to some of the concerns, particularly over particular industries today, that CNI stress testing is taking a front seat as far as the more important things to do today?
It certainly is. The challenge right now is it's really early in the process to know really what to hone in on, because nobody knows with the tariff implications and other things that are going on in the economy, what is this going to mean for my portfolio? So how do I focus my portfolio? I guess my suggestion to that would be focusing in on the largest industries that you have. Now, CNI as a whole is a much more data-heavy process than a CRE stress testing, because CRE, you're limiting your metrics to a handful of items, cap rates, cash flows, et cetera. When you're looking at CNI stress testing, you're really stressing the operating statement of each borrower. So you're looking at changes to, costs and margins and revenues, and then translating that towards an EBITDA calculation and then moving forward. So it's much more data driven. So what we recommend when we're looking at CNI stress testing is to identify your largest concentrations that are the riskiest segments for you. And don't worry about necessarily capturing all borrowers in that segment. Look at the top 20 borrowers or the top 15 borrowers, get the data for them, start the process, and see what the results are telling you, and then drill in a little deeper. So I think it's going to evolve over the next 12 months, but banks are certainly starting to, as you know, become much more interested in developing programs around CNI stress testing.
Great. So you can give us some examples here of the output from a stress testing process.
Sure. And this is an example of a CNI segment. And what we're really measuring here, and we're looking at it from a standpoint of making adjustments. And this is a very simplified approach, making an adjustment to revenue, decreasing that revenue amount and increasing an expense item. And then ultimately as well, increasing debt service to reflect changes in interest rates. So what we're really looking at to measure here on a simple level is we want to measure cash flow from a debt service coverage or a fixed charge coverage ratio. And what is this showing me with leverage? Building 3 scenarios, an initial, a moderate, and a severe in a series of changes to reflect those. One thing dependent upon you'll see here where we're talking about, we have a weighted average, we have an adjusted weighted average. A lot of times what you want to do when you're doing weighted averages is if removing a high and a low that have the ability to skew the overall results. So what we like to do is we like to do a segment average when we're doing this, and we do a weighted average, and then we will remove the highest and the lowest and calculate that again. In here, we're trying to measure the coverage ratio, both debt service coverage and leverage ratio. And then also within those balances or within those ratios, we want to look at how many loans fall below a certain threshold or go above a certain threshold. So as you can see here, we're looking at borrowers below 120 times debt service coverage. In each scenario, what is that? How many borrowers go below that threshold? And similarly, on leverage below, how many borrowers exceed that 4 times leverage threshold under these scenarios? So again, this is one example, a simplified example of how you could set this up, in some of the measurables that you might want to look at when you're doing this.
Great. No, I think it's a great example, and it shows at a glance what the potential impacts could be. So to wrap up this, and by the way, Todd, this has been great, and there's a lot of detail here. I know people are going to have to watch this over and over again to pick it all up, but maybe you can sort of give them, this looks like the summary of really the potential impact on the bank and why this is important.
Yeah, and there's a lot of numbers on this page, right? So it's small and everything like that. But what this is illustrating is a geographic stress test. And in this situation, there was a measurement of New York City, DC, and California. And we're measuring, this is a CRE measurement at the end of the day to look at what the changes are from an LTV standpoint and a debt service coverage standpoint. And how does this then translate into capital? What does this mean? I mentioned earlier about potential collateral shortfalls. When we're looking at a stress test of doing these variables, the output results of loan to value and debt service coverage would create some sort of a shortfall. So if the loan goes above a certain threshold, let's call it 100% LTV, and the cash flow falls below 1, there is a presumption made that there's a shortfall that could exist there. So when you add all those shortfalls up in the portfolio, how does that translate into capital? And in this example, you could see the capital ratios under the moderate in severe scenarios are reducing by the amount of the potential collateral shortfall. And you could sometimes banks are getting more complex in measuring this. Really, you could do a more simplified calculation to say, what is, if I add my potential shortfalls into my allowance, assuming I'm going to provide for those amounts, and just push it all the way through the leverage ratios, what does that tell me? So again, just a couple of examples of techniques you could use. I guess on the last 2 slides, really, when you're building a stress testing scenario, there's a lot of different ways to do it. And we get questions from clients all the time and say, hey, what about this or what about that? So there's really no rule book out there that says this is how you have to do it. If you're building these scenarios in order to make insights into the portfolio to ultimately tell you what you're trying to get to, there's nothing wrong with that. So there's no playbook or prescribed methodology on how to stress test. It's just a basic foundation of where you start, more or less. So just wanted to add that.
Yeah, and Todd, before we could leave this detailed investigation of credit stress, once you've identified potential areas, vulnerabilities, either in this case geographic, but it could be, as you mentioned before, it could be certain property types. What would you recommend that the bank do with that information? How actionable is it? Well,
it's certainly actionable information, but it should also not be the alarm bell shouldn't sound. Meaning it shouldn't raise to the point of an emergency. One thing with stress testing is you do want to trend the results over time. If you do a one-time point in time analysis, you're making your assumptions based on a series of things that you've identified, and you're getting results, and those results are going to give you some insights into the portfolio. But you certainly want to trend this over time, and you certainly want to evaluate what this impact could have on the different areas of the bank. So a lot of times, this information is being communicated with audit committees in the board and the enterprise risk management committee, as well as internal executive management to understand, is there areas we need to make further investigation on? It could be loan review too. There's stress testing results here. You're seeing vulnerabilities in a certain segment or a certain industry. That turns into an independent, focus from a loan review standpoint. Let's hone in on these and validate that the risk ratings are accurate. And is there any unforeseen risk that might exist in the portfolio that we might not otherwise be aware of? So there's a lot of different ways that could be utilized for sure.
Well, yeah, clearly this is one of the reasons why the regulators are so intent on seeing banks establish repeatable stress testing programs, because as the audience can tell from this presentation, there's a lot that you can learn. There's some very important metrics that can come out of it. So thanks, Todd, thanks for your time and appreciate that. And we'll circle back to you at the end, talk a little bit about stress testing in today's environment. So, Eric, you've been very patient. We appreciate it. And we appreciate CFO Consulting Partners lending you to us for this important presentation. Can you give us an overview of liquidity stress testing and possibly some of the differences between that and what Todd's been talking about?
Sure, Peter, and thank you. I'm happy to be lent. It's a pleasure to be with you both and with the audience. I think the difference between the liquidity stress testing we're going to be focused on now is that this is a bank balance sheet stress, not related to the client per se, the individual client. It's related to the entire funding mix, which includes depositors and includes and other borrowed funds that they would say on the call report, which are FHLB advances, maybe borrowings from the discount window, or even perhaps some debt issued at the bank level. The other difference is that we don't have information on specific borrowers, specific segments, which we're looking at here per the regulators. And this comes from the controller's handbook, this slide and the next slide on liquidity, is that we want to set up scenarios. And these scenarios are both market-wide and idiosyncratic that can, to a particular bank, that can be useful. By no means there are probably about 20 scenarios that we'll see here. There, by no means should people be thinking to use all of them, but they should pick out the ones that are important to them, important to the marketplace. One of the things that we need to think about stress testing is that there is a market contagion, as we saw in March 2024, with the failures of Silicon Valley Bank and then on to Signature. And there were a lot of other banks that were saying, well, they look like these other banks. We have to look at them too. And that caused liquidity pressure for those banks, some of which were forced into transactions and merger transactions, others of which were able to weather the particular storm. And the focus on liquidity stress testing is to get an idea of what the storm might look like, and then what you can do, remediate to do, and actions you can take to fix it. And it relates, again, not so much to the absolutes as it might with a particular borrower, but to the policy limits the bank has set for its liquidity ratio. There is no real regulatory guideline for a liquidity ratio, but each bank should have its own policy limit for a liquidity ratio that it doesn't want to fall below. And if it does, it should adjust it upward.
There's a lot of events here, Eric. I mean, I can see that. I know this comes from the controller's handbook, so there's a lot of different ideas here. Are there particular ones you think that are the most important to focus on for a bank?
Well, I think the bank has to set up a mix of market-related events and idiosyncratic events specific to the bank. And if we flip back to the first page there, Peter, if you would, for a second, you'll see that there is an actual or threatened watch or downgrade for a specific bank in terms of your external credit rating. And that would be something that's idiosyncratic, and that would make it more difficult to access wholesale markets outside of the FHLB and FRB, and would also cause the uninsured depositors to have a bit of nervousness. So that's an idiosyncratic one. If we flip back to the second page, you'll see a market-related one, which is the inability to sell assets or the inability to securitize assets. Securitization one is particularly interesting. Back in the financial crisis, 2008, 2009, the securitization markets froze up. So banks who are involved in securitizing mortgages, securitizing auto loans, RV loans, any of the other kind of assets that people package and sell out in order to get funding for the next round of originations and the financing for those assets, were unable to access them. It didn't have anything to do with the specific bank or the quality of their assets or any of their business they were doing. It just the investors weren't there because we were in a financial crisis and they were keeping their money in their pockets. So it's important here to select a blend of market-related things and idiosyncratic ones, which are specific to the bank.
And tell me, can you speak a little bit about, there's a lot of discussion about deposits, for example, above the insured portion and the volatility of that and how that might have even played into you said the March Madness from a couple of years ago. Is that a factor into the stress testing plans as well?
It does, because you need to think about your deposits in a tiered structure. So to the extent that you have uninsured deposits, understand that those are more risk sensitive and those will be more likely to go if any of these events happened. So you think of those going first. The insured deposits, those under $250,000, some of those should go, and you should have in your asset liability modeling what is referred to as deposit betas and how either as interest rate changes or as some of these stresses happen, how much of your deposits, your insured deposits, will leave. I mean, some people, even if they're insured, don't want to be at a bank that is under particular stress. So if you've got your ratings downgraded, or if you've had a particular bad earnings report, you might find people say, I may be insured, but life's too short. I want to move my deposits to a different institution, which they seem is better. Less likely than the uninsured deposits, pardon me, will or tendency to flee. And also, you have to segregate between what is a customer of the bank versus a deposit you might have gathered in a wholesale environment, and that is either through a broker deposit or through an internet listing service or through a one-way transaction with some of the deposit management services like IntraFi, Tang, Ampersand, et cetera. Those people have no relationship with your bank. And they'd rather not endure the pressure of being in a bank that's had some adverse news, and they will leave as soon as possible, depending on the nature of their contract.
Awesome. Well, thanks. I think that really drives home what's going on today and why some banks got particularly nervous after what happened a couple of years ago with Silicon Valley and others. I'll move on now to this is an awesome slide. I look forward to you describing this as the results from a stress testing exercise.
Yeah. So not wanting to be a negative presenter here, I've chosen a scenario here which is people might say is a good problem to have. It's for significant uncontrolled growth. So things are going really great for this bank. Borrowers are wanting to borrow money, and they're good quality borrowers. The economy is going great, or maybe a local manufacturer just got a big contract and they need to draw on their lines. All sorts of good things are happening, but the problem with liquidity is that's not necessarily a good thing because you have to fund these loans, and you might not have the deposit flow or the availability of your organic liquidity to be able to fund the loans. The measurement here is we're stressing what happens to our liquidity coverage ratio, the LCR, and how that is managed against our policies. In this case, the policy limit is 1.5%. So you can't have a liquidity coverage ratio fall below 1.5%. But as people are beating a path to the bank's door, and as the borrowers want more loans, and they're very good borrowers, and they're customers, and you've invested a lot in these relationships, you don't want to deny them. And you can see that if you keep funding these loans without taking some remedial actions, that blue line falls below the horizontal line there, which is the policy limit for the liquidity coverage ratio. And actually, it falls so far below the policy limit that adjusting your policy, however you might think about that, is probably not something you can do if you get out into Q4 27 and Q1 28. I frown on the adjusting the policy strategy because it's kind of moving the goalposts, and regulators don't like it. And as a CFO, I don't like it. I prefer to have strategies to remediate it. And by the way, the liquidity coverage ratio, it comes from a Basel III formula that is technically applicable to large banks, but as we know, there's a common regulatory occurrence, which I refer to as trickle down, which is, yes, it doesn't really apply. It only applies to the large bank, but we think it's a best practice community bank, and we'd like you to adopt it. So without denying that fact, we just adopt it in our community bank clients and say, yeah, this is what the regulators are going to want to see. The high quality liquid assets are it's really a tight definition. I think it relates to, I know it relates to cash, treasury bills and treasury bonds, and agency securities. Now it's Basel, so it has an international flavor. If you read the definition, it also has other government kind of backed securities from EU countries, et cetera. But for your basic community bank in the States, it's treasury, agencies, and bills and bonds and cash. So the real challenge on the stress test here is, how do I fix the problem that we have, the declining blue line there, and what actions can we take? And the actions that I think we can take is, you pledge your available assets to the FHLB and discount window. This is like a double-edged sword, because in order to retain your municipal deposits that many community banks have, those frequently have in their agreements that they have to be collateralized with securities. So you can't take the securities away from them because those deposits will leave. So you have to make sure that your unpledged assets are then available, pledged to the FHLB or the discount window, and then you can borrow against them. We have to, it's a little balancing act, because once you're encumbered and once you've got the cash, those things can't be counted again as high quality liquid assets because they're pledged, but you have the cash, so it doesn't really change the ratio. The other thing you can do is you can sell securities. That is also a bit of a game. You're borrowing from the future to pay for the present. But in my experience, bank failures happen because of liquidity problems, first and foremost, and second, asset quality and bad management practices. So giving up income in the future to solve your liquidity problem now is probably a good thing, because bank failures don't happen because banks are earning less in the future. Bank failures happen because they're out of liquidity now. And it's a reasonable explanation to somebody that said, well, why are you earning less now than you used to? Well, I had a liquidity problem I had to fix. You can also alleviate liquidity pressure on the asset side by participating in any new loans you have. As they come in, you can participate on this growth due to this wonderful thing that's happening in the economy. You can participate those loans and really alleviate your liquidity pressure by getting cash in for the part you're participating. Then you can also securitize or sell your existing loan portfolio. again, to bring the cash in to meet the growth. The liability actions get very interesting. Well, interesting to me at any rate, because there's a real mix here. And the challenge to managing liquidity stress testing is twisting the dials in a way that you solve the remediation, you get to that green line, below the red line, and you balance it in a way which is suitable to the bank. And so you're managing both your customer both. You're managing your customer relationships, you're managing your wholesale borrowing relationships with the FHLB and the Fed, any other external borrowing relationships you might have, as well as relationships with the IntraFi, the Reichentangs, et cetera, R&T, and the internet services. So you really have to figure out the right mix here, and that's going to be different for every bank. And that's why stress testing is so valuable, because it allows you to twist the dials and see where you are to get the optimum results. It's so very similar to what Todd was talking about. You need to get to the optimal risk profile here. And so you can borrow, and you want to borrow blended term funds. You don't want to solve the problem, because if you look at the stress test, it runs out many quarters. You don't want to solve the problem just today. You want to solve the problem over time. So you want to borrow blended term funds from the FHLB or the FRB, assuming you have the collateral. You can prudently access the brokered deposit market, and that's a wholesale market, confidence-sensitive funds. But in this case, we're not worried about the bank's reputation, because we've got a good problem. We've got new customers, and people want to do business with us. So it's less of a issue in this kind of stress test scenario. And you're going to want to set up the one-way buys with IntraFi and R&T and other services like that, and evaluate whether internet listing services such as Quick Rate work. Now, in order to make Quick Rate work for a bank and really get funding in, you have to be at the top of the list, and that's a nationwide list. So if you're going to offer the best insured deposit rate in the country through the internet, you really have to be prepared for the tsunami of cash that's going to show up pretty much instantly at your doorstep. And you have to be prepared to, on the operations side, to process it, on the, and get it onboarded. You have to be prepared for the economics, because you're offering a higher rate than you otherwise would, and that would impact your NII and your profitability in the future. And you have to be prepared for the fact that when you drop the rates, that flow stops. So you have to have a strategy within the strategy to figure out whether you want to do that. But you are able to solve liquidity problems pretty quickly and easily with that, but it has lots of implications.
When you look at all the different activities that you could be doing, is there one particular easier to implement process that would have the most positive impact of all these options?
I believe there are probably three. The first, obviously, is the FHLB and the FRB discount window. Now, you guys like me have attended a lot of conferences, webinars, various things where the regulators are up saying there is no stigma to borrowing from the discount window. This is particularly after March of 24, where one of the problems Silicon Valley had was they didn't want to borrow from the discount window because they thought there was a stigma attached that meant they were failing. They went to the FHLB, and the problem, it's just a mechanical problem with the FHLB. If you want to borrow money from the FHLB, they have to go raise that money, and there's a time lag. And if you're having a run on your bank, that time lag might not be sustainable. It's a lot quicker to get money from the Federal Reserve because they own the money. They don't have to raise it. And they're trying to dispel the notion that that's a bad thing to do. They want you to do that. And in fact, they will take different collateral. They will take loan collateral that the FHLB does not take. They'll take commercial loan collateral. So it's a really good option to have access to both of those borrowing facilities and understand which one can get you the liquidity at the time you need it. The other thing that's useful to have, I think, and useful to do is to be able to have thoughtful pipeline management of your loans so you know what you can participate new loans as they come in. And if you have relationships with your correspondent banks, people who want pieces of your loans, that can be a flow business. And in this situation, that can be pretty easy to access because your credit underwriting is well understood, your credit performance is well understood, and you have the relationships. Those are the two, Peter, that I would see as the quickest way to solve the problem. The third way, I think, which gets you to a good answer, is the one-way buys with the deposit management services, IntraFi and R&T. And those would, they're not typically, these services offer reciprocal deposits, so you can manage a client's insurance level. You can also do one way. You can also just say, I'm just not going to sell you deposits. I'm just going to take deposits from your system. And that could be very helpful, but you have to have the infrastructure set up to do that. So those three are kind of good ways to initially manage it, and good dials to twist, and then you can end up with using the rest of your options as you need it to solve the problem.
That's great. I mean, I think you did a great job explaining both the complexities and the basic concepts. That some of this is basic banking. But it also shows the similarities of the two methods in that we're taking actions based on what could happen. We're testing how the market is impacting the bank and really helping the bankers make the better decisions, which I think is the bottom line.
I think that's the point. There's one other point, if I may, Peter. We're talking about stress testing today. But there's another tool for liquidity management that the regulators that you can also find in the liquidity handbook by the OCC. It's a sources and uses statement, and it forecasts out your liquidity position going forward. It's not a stress test. It's just the things that the big loans you're going to be funding, the seasonality, for example, of your municipal deposits as they fund school systems and pay teachers, et cetera. You take that all into account, you can understand where your liquidity pressures are going to be without a stress test, just business as usual. And that's a best practice as well that people should have. And they should have that in hand before they embark on the stress testing, because that will give them some view of how their liquidity plays out on the calendar.
Interesting. Good stuff. Thank you. Thanks, Eric. Thanks for sharing that with us and the audience. And I'm sure there are questions and all they can follow up on the specifics with you. Well, I have up on the screen why stress testing is important today. Let's wrap this up. It's a very informative discussion with maybe something relevant to the conditions we're seeing today. Todd, maybe I can start with you. Can you give us a couple of minutes or thoughts on where using, commercial credit stress testing is particularly valuable in considering today's marketplace?
Sure, Peter. In the past, it's been typically an annual stress testing has been an annual or maybe a couple times a year requirement or checkbox that banks have been doing. In today's environment, with ever-changing macroeconomic conditions, and some analysts are saying we're heading into recession. Some others say we're not. Interest rate environment, what is going to happen there. And at the end of the day, doing this on a much more deliberate and, continual exercise, continual process is very important. Another thing is you don't want to just repeat the same stress testing over and over again. You want to do geographic, then you want to shift some focus on C&I and et cetera, et cetera. So I think today being flexible and agile to slice the portfolio in meaningful ways and being able to repeat that process and do it on an ongoing basis as part of your overall, risk management infrastructure and incorporating that into that, I think is important. So, yeah.
So stay vigilant, you have a repeating process, and look and watch the trends.
Yeah. Peter, I think the taking what Todd said and varying your stress testing, I think communication throughout the organization, particularly to senior management and the board of directors, is a best practice. And you should get the board used to seeing the results of these stress tests, educate them that it's a stress test and a hypothetical scenario and not a sky is falling emergency right away, but that they should be engaged in understanding that first, management is doing it. Secondly, that there are options and what those options could be. I prefer to see liquidity stress testing and obviously interest rate risk stress testing at ALCO on a quarterly basis for my clients.
Yeah, well, I think it fits in what you said very well with the OCC slide in the beginning of this presentation about the importance of doing this and then timely and meaningful reporting to the board and to management of the results. Because if you do these exercises, even if you do them well and they're not understood and they're not appreciated, they're not going to bring the value to the bank that we're looking for. So
also to Todd's point, if there are a variety of stresses presented, and then they can see that, oh my goodness, we have a geographic concentration here. Oh my goodness, that region is under pressure. They've sort of got the context by which they can then manage.
Great. Okay. Well, I'd like to thank the panelists, Eric and Todd, sharing some really good wisdom with the audience and, helping us understand that stress testing is a key proactive risk management tool, whether it's used for looking at concentrations of credit, whether it's looking for managing your deposit outflow and your overall liquidity. It's key. And in times of uncertainty like this, it can be extremely helpful. Thank you to ProSight for sponsoring this presentation. We appreciate it. And thanks to the audience today. And hopefully you learned something today. And if not, at least you found it interesting. Thanks very much.